Hello, everyone. My name is Olbek, and in this presentation, I will discuss how a major streaming company accounts for the money it invests in producing original content. So, streaming platforms spend some billions of dollars creating exclusive movies and television series, but these costs are not treated as immediate expenses. Instead, accounting standards require companies to record many of these production costs at assets because they are expected to generate benefits over several years. So I will explain how this accounting process works by following a hypothetical example for streaming series. The presentation covers three important accounting transactions. First is capitalizing production costs and amortizing the content asset as viewers will watch the program and recognizing subscription revenue over time. I will also show how each transaction affects the accounting equation and why media headlines sometimes misrepresent the financial impact of streaming investments. Finally, I will explain why proper accounting provides a more accurate picture of profitability. So this example focuses on hypothetical original drama series produced exclusively for a streaming platform. The company invests $50 million in development, filming, production, and related overhead costs. According to its accounting policy, these costs are capitalized as non-current content assets instead of being recognized as expenses immediately. So this treatment follows the matching principle because the content is expected to generate subscription revenue for many years. The company then applies accelerated amortization, meaning a larger portion of the cost is recognized during the early period when viewership is highest. Revenue is handled differently because subscription fees are collected in advance and recognized gradually as the streaming service is delivered. This accounting approach separates production. This accounting approach separates production costs from subscription revenue and ensures that financial statements reflect economy reality instead of simply recording cash received and cash paid during the reporting period. The first accounting transaction occurs when the company spends $50 million producing the new series. Since the program is expected to provide future economic benefits, generally accepted accounting principles require these costs to be capitalized rather than expensed immediately. The journal entry records a debit to content assets and a credit to cash. Although all cash decreases, the company gains a valuable content asset of equal value. So total assets remain unchanged. Liabilities and equity are also unaffected by this transaction. Liabilities and equity are also unaffected by this transaction, as this demonstrates that accounting does not always treat cash payment as expenses. Instead, the company recognizes that the investment will create a value over several years, allowing production costs to be matched with future revenue generated from subscribers who watch the content. So the second transaction records amortization after the series is released. During these first months, the program attracts strong viewership, so the company recognizes $15 million of amortization expenses using its accelerated amortization policy. So the journal entry debits amortization expenses and credits content assets. This reduces the carrying value of the asset while recognizing that part of its economic benefit has now been consumed. As a result, asset decreased by $15 million and equity also decreases because expenses reduce retained earnings. This transaction illustrates the matching principle by recognizing production costs over the periods when viewers actually consume the content instead of recording the entire expense at the time production was completed. The third transaction explains how subscription revenue is recognized. Subscribers usually pay their monthly fees before receiving streaming services, so the company initially records these payments as deferred revenue, which is liability. As the streaming access is provided throughout the month, the company recognizes $80 million as earned revenue. The journal entry debits deferred revenue and credits subscription revenue. Cash does not change because it was received earlier. Instead, liabilities decrease while equity increases through higher retained earnings. This accounting treatment follows the revenue recognition principle because revenue is recognized only after the service has been provided. It also shows that subscription revenue is based on the overall streaming service rather than the performance of any individual movie or television series. When all three transactions are combined, the accounting equation remains balanced throughout the process. The capitalization of the production costs changes only the composition of assets. While amortization reduces both assets and equity, revenue recognition decreases liabilities and increases equity because deferred revenue becomes earned revenue. Overall assets decreased by $15 million, liabilities decreased by $80 million, and equity increases by $65 million. This change satisfied the accounting equation because assets always equal liabilities plus equity. This example demonstrates how journal entries accurately capture different economic events while maintaining balance in the financial record. It also highlights the importance of double entry accounting in producing reliable financial statements for investors, managers, and other stakeholders. So the final slide examines how media headlines sometimes oversimplify streaming company finance. So news reports often suggest that the entire production cost of a show immediately reduces profits or the subscription revenue can be directly linked to one successful title. In reality, neither assumption follows generally accepted accounting principles. Production costs are capitalized and gradually amortized based on viewing patterns, while subscription revenue is recognized evenly as the service is delivered to customers. So these accounting methods provide a more accurate representation of financial performance by matching expenses with the benefits they generate and recognizing revenue only when earned. So understanding these principles helps investors, managers, and the public interpret financial statements more accurately and avoid misleading conclusion based solely on cash spending or popular headlines. Thank you for the listening. Here is the references I used for this presentation.